Grandpa Buff is in the news again, like always. This guy is just so controversial. He's basically like the investing world's Kanye West. Look at him in the club just throwing up the rock. Really, Buff is just trying to live his life, but everybody's always in his business, including myself, obviously with all these Buffett videos. And the latest Buff business that everybody's worried about is Buff's portfolio. They're worried it's not diversified enough, and that's what we're going to talk about today. And diversification is a topic that leads into position sizing and portfolio construction, which are all super important topics if you're investing in the market. And unfortunately, most people don't think about these things, but it's not a beginner concept. It takes a while to get it right. But that's just one of the topics we go over in our free training. We talk about the strategy we use at Fallible that includes all those things: position sizing, diversification, everything that we're going to talk about in this video. It goes into more depth. So definitely check that out if you haven't already. There's a link in this video and down below in the description and comments. It's free, and it's dangerous to be in the market if you don't have this information. So do it today. So the big thing everybody is talking about is that Buff owns way too much Apple, at least according to them. Apple shares now comprise 43% of Warren Buffett's portfolio, with Berkshire Hathaway owning 91.3 billion worth of Apple. It's a lot of Apple. And it's funny to think of Buffett in a company like Apple that's high tech, sleek, clean, fresh smelling. I'm used to thinking about him in a Dairy Queen. That's more of a Buffett investment, where there's a permanent dry syrup smell in every store you go into, and absolutely anywhere you touch is sticky. And there's always some kid like this one right here just over your shoulder waiting to drool ice cream on you. Look at that, mouthful, just waiting to come out over Buffett's shoulder. That's what I'm used to Buffett being focused on, not something like Apple. But Buffett is a fan of companies with a sustainable competitive advantage. And in Apple's case, they own 58% of the smartphone market. And we all know Apple is such a strong brand, and not only do they control their hardware, but they control their software too. And that's a huge moat that they've developed over the years. People make fun of people without Apple phones, like me. That's how strong their branding is. So of course that's going to be attractive to a guy like Buffett who loves moats. Buffett is also a big fan of the CEO Tim Apple. Since he's taken over, Apple shares have risen 688%. And another thing that he loves about them is that they periodically borrow money while it's cheap and then repurchase shares, which a shareholder like Buffett, of course, he's going to really enjoy that. As Buffett said, "I don't think of Apple as a stock. I think of it as our third business. It's probably the best business I know in the world." So Buffett is an Apple fanboy, and he owns a ton of their shares. I think Berkshire is the biggest shareholder in Apple, but people are losing it because they think that's too much of a big bet in one stock. There's not enough diversification. It's dangerous putting all your eggs in one basket. It's the old investing saying, diversify. But the funny thing about that saying is that it's not necessarily true. So like Buffett said, diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. And that same statement has been echoed by many other extremely successful fund managers like Stan Druckenmiller, the legend, the billionaire, the market wizard. He's famous for saying you should put all your eggs in one basket and then watch that basket very closely. So that's the real truth about markets, about how they work. The thing is, markets don't distribute returns evenly. The returns are few and far in between, or at least the opportunities. So for you to actually take advantage of those few opportunities, you need to make sure that you're betting enough in them. So in the case of guys like Buffett and Druckenmiller, they're really good at this. They bet huge amounts. That's why Buffett is so okay with putting so much money into Apple. The truth is that diversification actually kills your returns. It's not the way to approach the stock market. So I see people with their accounts and they have 15 to 20 stocks. And at that point, you're basically like mimicking an index. Why aren't you just in an ETF? Because you're not going to be able to properly benefit off the few individual stocks that take off because your money is so spread thin, between 20 other stocks. And another thing is, if you're investing in 20 different companies, how much do you know about each of those companies? At least for the people that look at fundamentals. There's only so much time in a day, and you can't know that many different business models. Well, you can over a long period of time and studying hard every day, but the most successful investors at the end of the day, they invest in just a few companies. Now, the big caveat here is that you do need to know what you're doing. Otherwise, yeah, it does become very dangerous putting all your money into one thing. Like if you're putting all your money into Nikola, that's insane. You're probably going to blow out, which is another reason when we talk about betting big, the guys who are the best at it have been doing it for decades. They're literally the best in the game, because to be that good and have that much conviction, it's tough. You really got to know what you're doing. So in our strategy that I talk about in this training, it's a momentum-based strategy. So what we're doing is finding the highest momentum stocks in the NASDAQ and investing in those. But we have a strict limit. We're only investing in the top 5 stocks. It's not the top 1 because that's too dangerous for our strategy. That's too concentrated. But it's not the top 10 either because that's too watered down. It's too diversified. 5 is our sweet spot, and that's how we're up over 40% this year, because that's the right level of concentration for our strategy to really reap the returns of that momentum. Now, that doesn't mean diversification diversification isn't smart. It is to a point, it just depends on how you do it. So when we're talking about the stock market in particular, if you're gonna buy a bunch of different stocks, then you're almost index investing. But if you talk about diversification with a guy like Lil Kamidalio, then he's talking about diversification across different asset classes, because he does the whole risk parity strategy. So he's looking at volatility and he wants everything to work in every scenario. So his idea is that the correlation between something like gold and stocks are going to be very different. So his idea is that like the correlation between something like gold and stocks is going to be small. So if he diversifies his money across gold and stocks, if stocks are going down, maybe gold will be going up. So he'll still be able to get those returns that he wants. And he doesn't just stop at stocks and gold. There's a bunch of other things. There's commodities, there's fixed income. You could even throw currencies in there. But that's real diversification across different asset classes that all work differently. So that type of diversification makes more sense. Me personally, I like system diversification. And this is what a lot of hedge funds do as well. Or you could call it strategy diversification. So all our Fallible members have access to this strategy, which is a momentum strategy, the one I describe in this training. But there's also another strategy that we use that's more based off global macro. So instead of measuring just momentum in the market, it's measuring different things like the relationship between high yield bonds and stocks. And then it distills all that down to give a signal. So I like to use both of those systems together. So I diversify my funds among each system, because each system is going to perform a little bit differently depending on the environment. So if my momentum strategy is in cash because the market is looking bad, my other global macro strategy might be long bonds because they're taking off. And a lot of times they might come to the same conclusion, like either be in stocks or not, but other times they come to different conclusions. And I want that diversification because they're taking different inputs. Now, both of them, and this is important, they are solid strategies on their own, but when you combine them together, you do get that diversification. So you're not betting everything on one strategy. Even though it does work over the long term, you can still get returns if the market turns into the type of market that doesn't work as well for that strategy. So that's how I like to do it when it comes to diversification. And a lot of funds actually use this same strategy. And we actually work with funds that use this same strategy that I teach in this training. And the way they're using it is on one portion of their portfolio, because they have a multi-strat portfolio. So at the end of the day, we don't got to worry about Buffett being so heavily invested in Apple. It's all part of the plan. That's how you get good returns in the market. You do got to concentrate. And again, we go over all of this in terms of diversification and position sizing, which becomes a really important part of this too. Go over it all in this free training. Link in this video and down below in the description and comments. Definitely take it today to make sure that you are diversifying the right way like Buffett does. One more thing I want to talk about is the last video that we did. It was a market review where I talked about no maskers and they got very angry. Too funny, but we got a lot of comments like this. You're a sheep. Go drink the Kool-Aid. Because I said, I was wearing a mask and people should wear masks. And that was really the tamest comment I could find, because most of them were so angry and so violent they were automatically blocked by YouTube. Now, there are a lot of good arguments made in the comments about why we don't need masks. For example, the virus particles are this big and masks only block particles this big, so it doesn't matter if you're wearing it or not. Or that the CDC and the government are all liars, they keep flip-flopping and you can't trust anything they say. Or that not wearing a mask is the best way to protest government control. So these are all things that I at least somewhat agree with. There is some validity in those statements. But at the same time, obviously, there's a ton of arguments for wearing masks as well. So here's the way that I think about it. If you're watching this channel and you're investing in markets, then what are you? More than an investor, you're a risk manager. So in that sense, what's the downside of wearing a mask? It's annoying, sure. I hate it, but there's really no negative effects. But the potential upside, though, of the protection that it may provide is huge. So at that point, what is it other than another asymmetrical bet? Very limited downside, which is really just, annoyance, for huge upside, or potential upside, we'll say. And if you're all about markets, then that's a good bet that you should be taking every time. So why wouldn't you wear the mask? And what we're dealing with is a scenario with imperfect information. Because I agree, like the government, CDC, they lost all trust when they first came out and said masks didn't do anything. They lied and now they flip-flop, so how are you going to trust them? So we can call it imperfect information, right? Because even the experts are confused as hell. So if that's the case and we don't know what's right and what's wrong, wouldn't you take the more conservative approach and mitigate your downside risk as much as possible? Are you that certain about your own off-brand research for from some random articles online to say that masks 100% do not have an effect. No way. Like, you can't be that confident. So the way I equate it in my head, because, you know, I think in terms of markets, not wearing a mask is basically like researching a company and being so convinced by your own research that you invest your entire life savings into that company. And you're so confident that you don't put any risk point on it. There's no margin of safety. You just say, I'm going to ride this until the end. And what's going to happen when you do things like that? You're going to blow out your account. There's no way you should be that confident in any bet. That's why this channel is called Fallible. We're willing to change our minds as new information comes in, because we're playing games of imperfect information. You're never going to have everything you need to make the absolute best decision. That's why it's a bet. The most you're going to have is like 60% of the information. So that's why when I look at masks, I'm like, yeah, of course I'm going to wear it, because I'm going to mitigate my downside risk as much as possible. Doesn't mean I trust the idiots in the government. I'm going to do my best to protect myself, even if there's only a small chance that the masks work. Now, some of the no maskers on our channel were completely fine with my jokes. They get it. But for those no maskers that were so offended by my jokes and threatening to unsubscribe, or do some other things that I could care less about, well, you could go crawl back into your safe space to cry about how your feelings were hurt. And go ahead, continue to cling on to your fascist PC culture, because here at Fallible, we spit the truth. Patui! Caution, you have entered the no spin zone. This is the Fallible factor, and all you snowflakes can leave now. And that's how I feel about it, very strongly. But anyway, feel free to take this training. You know, you don't need a mask or anything. It's very safe, 100% safe. Maskers and no maskers, you're all welcome to join. And make sure you subscribe, you know, if you're tired of all the spin out there and you want to enter the no spin zone. The Fallible factor works for you. So subscribe, and I'll see you in the next video. Stay fallible out there. Good night.